Welcome to Kitco News. I'm Niels Christensen. Gold prices are holding critical support above $1,800 an ounce, and investors see a lot more upside potential to come. Here to talk about his expectations for the second half is Lukman Otunuga, senior market analyst at FXTM. Lukman, it's a pleasure to talk with you. Thank you very much for joining us today.
Thank you very much for having me here. It's an absolute pleasure.
So what do you think? Gold passed major milestone. We're above $1,800 an ounce. How much room does this rally have, do you think, as we look to, the second half of the year?
I think gold's explosive appreciation over the past few days is simply the result of many macro drivers simply harmonizing. As things stand now, I believe gold actually has the potential to rally towards 19,000 and that 1920 all-time high and even higher. And the reason is, I'm going to explain. Firstly, we know how the world is still struggling to nurse the deep wounds inflicted from the first round of lockdowns. And we can see rising coronavirus cases in the United States and other parts of the economies are raising fears over the world coming to a standstill once again. Now, if this does become reality, I think the consequences could be quite crippling. And this is one theme that is really boosting appetite towards gold, on top of the geopolitical tensions and uncertainty over US-China trade developments. Another thing is that we know that central banks across the world have actually been cutting interest rates, and it's fair to say that we are in an era of low interest rates, with major interest rates near zero across the world. Now, gold is a zero-yielding asset, and it tends to perform really well in a low interest rate environment. On top of that, some central banks have actually adopted negative interest rates, and we can see in some countries, bond yields are paying negative as well. So most investors are thinking, even though gold is zero yielding and doesn't offer anything, it's better to hold on this than to hold on to an asset that you're forced to pay over a period of time. But I think the most important thing that is supporting gold is the fact that we've seen governments unleashing handsome fiscal packages. And, this is been one of the tools that have been fighting the coronavirus menace. But this is going to bite back because the heavy spending they're doing may widen the budget deficit. And this is probably a key risk that we may see, hitting market sentiment probably in the final quarter of 2020. So these four things are supporting appetite for gold. And when these things harmonize, I expect gold to continue pushing higher in Q3 and in Q4.
Interesting comments about interest rates. A lot of speculation about what the Fed is going to do, sort of yield curve control. Some people, negative interest rates appear to be off the table, but what do you think? I mean, do the Feds look to some way to control the yield? I mean, we saw in June the 10-year jump up to 90 basis points. It's back down from those highs, so that conversation is sort of taken a back burner. But expectations are something comes in September. What are your thoughts?
Yeah, I believe there is some speculation. It's too early to come to any conclusion, but there is some speculation over the Federal Reserve possibly taking this path. And naturally, this has been one of the key themes that have supported gold prices higher. But we just need to really look at the US economy in general and look at the conflicting themes that are, really weighing on investor sentiment towards the largest economy in the world. For example, if you looked at the latest jobless claims today, it looks like, there is some sort of stability. The most recent US jobs report beat market expectations. And retail sales shows that, consumers are actually spending. But on the other side of the equation, there's rising coronavirus cases in parts of the United States. So this actually has the potential to really threaten the United States, fragile recovery. Before this was happening, it was widely expected that the Federal Reserve would actually remain on the fence when it comes to monetary policy. But if things look to be worsening, this could be a move that the Fed takes, and naturally, such will support gold prices higher in the second half of 2020.
Interesting. And you actually had a report on this at the start of the week talking about risk sentiment and how it is sort of improving. I mean, we have seen better than expected data really drive the equity markets. And surprisingly, gold has withstood this. Like NASDAQ hits records day after day after day. And yet, gold managed to get above $1,800 an ounce. I mean, what do you think? I mean, why does gold investors not worried about equity markets?
I think this is just a classic example of a major disconnect between market fundamentals, economic fundamentals, and markets. Because, although, yes, it can't be disputed that economic data has been improving, the core themes weighing heavily on market mood remain present. Coronavirus cases rising across the globe remains a major risk to the global economy. We've got geopolitical tensions, we have US-China trade uncertainty. In the United Kingdom, we have Brexit. So there's just these many themes that are really, really hitting risk appetite. The major driver behind these, elevated gains in equity markets is the fact that, central banks have, enforced unprecedented measures. Those monetary policy bazookas and those handsome fiscal packages from governments have been the key things that have kept the stock market value alive. But if you want to really add color to this, imagine the equity markets like a child that's just experiencing an overextended sugar rush. Eventually, that sugar rush is going to fade, and when that happens, this could result in that steep correction many people are talking about.
I think with young kids, we are very familiar with what happens in a sugar rush. um, U.S. dollar. I mean, a big factor behind the gold rally has been a weaker U.S. dollar. Do you think, is this sustainable? Does the U.S. dollar look like it's in a correction, or is this just, short-term gyration?
Well, when we look at the dollar's performance in the second quarter of 2020, it's actually weakened against every single G10 currency, Asian currency, and most emerging market currencies. So the dollar wasn't certainly the king of the currency markets in the second quarter of 2020. Moving forward, though, I think when we're looking at the dollar, it's the world's reserve currency, and it's still considered a hot destination of safety. And for an extended period of time, we've seen that gold and the dollar have both been engaged in an aggressive fencing match. There is a possibility that dollar rebounds, and this is based on global sentiment. This is based on, if the United States economic recovery is faster than most people expected. But overall, I still believe that gold is, drawing support from other themes, not necessarily a weaker dollar, but geopolitics, global growth concerns, and other negative themes weighing heavily on sentiment. I think the momentum in gold is quite strong right now, and a stronger dollar may not be enough to really pull it into this party.
Thank you very much. Fantastic insights today. Thank you very much for coming on the show.
Thank you, Niels. It's always a pleasure.
For the latest in the precious metals markets, go to kitco.com. Stay safe, stay healthy.